Welcome to lesson 1, part 3 of the 8 stock investing categories. We now move on to the next category of stocks, having already discussed large growth, predictable, and cyclical stocks. The next stock category on our agenda is dividend stocks, also known as cash cows or income stocks. Now, like any farmer who keeps a cow so that he could milk it for a regular supply of milk, an investor would buy dividend stocks primarily for receiving a steady stream of regular income, for example, every quarter or every 3 months. This type of category tends to suit investors who are much older and are more interested in a steady paycheck, even though their money will not grow at fast rates, but will be growing at moderate rates. Mkulus and Gogos don't like drama, especially the drama that is caused by large cap growth companies like technology stocks. They prefer safety, stability, and a reliable source of regular income. That is why the majority of them are attracted to this category of stocks, which includes the likes of Clicks, Coca-Cola, United Healthcare, and REIT, to name but a few. Again, this is not to say go buy these stocks. It's just an example of dividend-paying stocks that I'm giving. You always have to do your own due diligence before you buy any stock. Now, not all companies pay out dividends. For example, growth companies like Adobe, Meta, and Amazon, which grow at high rates as high as 20% and above, they do not pay out dividends. Instead, they keep reinvesting their excess cash back into the business in order to sustain and propel the higher growth rates. So dividend companies are usually businesses that grow at moderate rates of less than 10% and are usually defensive in nature. These companies tend to be matured companies, meaning they've almost reached their peak in terms of growth and hence growing much slower into the future. So it doesn't make sense to keep pumping the extra cash into the business. So instead, dividends are paid out to shareholders, which sort of compensates for the lower growth rates that they receive. For any business to qualify as a great dividend stock, it must pass the following criteria that I'm about to give you. And I stress that all of the following conditions must be met, not some, not one, but all of them. And do not worry if you do not understand some of these terms. We will go through them in later lessons. So let's go through the 7 criteria. Number 1, dividend yield must at least be 4 to 5% or even higher. Number 2, dividend per share must be increasing consistently for the last 5 years. Number 3, net income, cash flow from operations must be increasing consistently for the last 5 years. Number 4, the share price must be stable for the last 5 years. In other words, the price must either be going up steadily or moving sideways. If the price is on a long-term downtrend, there is a big flag and you must investigate some more. Number 5, it must be a defensive stock, which we have spoken about in previous lessons. Avoid at all costs cyclical stocks like airlines, commodities, shipping, and property, to name but a few. These types of stocks are not good for dividends as they are very unstable. In good economic times, they do well and therefore pay out a lot of dividends. However, in a recession, they perform badly and so dividend payout falls. And that causes a big instability in your payout profile. You always want a steady stream of dividends that is increasing consistently over time. So to get a steady and reliable source of dividends that increase consistently over time, one has to invest in businesses that do well under all economic conditions. In other words, whatever the economic condition is, the company must still consistently have increasing sales, consistently increasing profits, and consistently increasing cash flow. And that is why defensive stocks are most preferable for this category. Number 6, the company must have a conservative debt. In other words, the debt servicing ratio must be less than 30%, but more about that in later lessons. The seventh condition, which is the final condition, the dividend payout ratio must be between 20 and 100%, with 100% being the maximum. And I will show you why I say that. Remember, as I've said in the beginning, all these conditions that I have outlined have to be met. But a lot of people make the mistake of buying a stock for dividends purely because it has a high dividend yield. That is very risky to just look at the dividend yield alone. Let me show you why that is so risky. If you look at the equation for dividend yield, it is dividend yield is equals to dividend per share divided by price per share multiplied by 100%. It is possible for the dividend yield to be high, as you see by this big circle here, whilst the dividend per share is dropping. How is that possible? That can happen if the price per share, which is here at the bottom, is dropping faster than the rate at which the dividend per share is dropping. So if this is dropping faster than this, then you will have a high dividend yield, but that is not a good situation. So it is important for the dividend yield to be high, like this big circle over here, whilst the dividend per share is increasing consistently, and the price per share must be either stable or moving sideways. That is very important. Remember that. Now, we also said earlier that one of the conditions to be met for a stock to be considered a great dividend stock is that the dividend payout ratio must be between 20 and 100%, with 100% being maximum. If we look at the equation for the dividend payout ratio, it is dividend payout ratio is equals to dividend per share divided by earnings per share. Now, let's have a look at example 1. Let's say the company has an earnings per share of 1 rand and it gives out a dividend per share of 50 cents. This means that the company, for every 1 rand in profits, it pays out 50 cents in dividends. Now, if you plug that into the equation, you get 50% payout ratio. Is that a good thing? Yes, it's a good thing. Let's look at a second example. If the earnings per share is 1 rand and the dividend per share is also 1 rand, meaning that for every 1 rand in profit that the company makes, it pays out 1 rand in dividends. If you plug this into the equation, you get 100%. Is that still good? Yes, it's still good. But once the dividend payout ratio exceeds 100%, that is not a good thing, because it means that the company is paying out more dividends than its profits. If we look at example 3, for example, we have earnings per share of 1 rand still and a dividend per share of 2 rands. In other words, for every 1 rand in profits, the company is paying out 2 rands in dividends. Now, that is not a good scenario. We do not want that, because think about it. Where is the extra cash coming from? You can't make 1 rand in profit, but pay out 2 rands in dividends. Where is that extra cash coming from? That extra cash would be coming from the business's cash reserves, which is not a sustainable strategy, as the company would eventually run out of cash if it continues to do that. And then when it runs out of cash, the company then would have to go and borrow more money in order to keep paying out these dividends, or it will have to sell new shares in order to raise capital to continue making these dividend payouts. Now, all of this is not good for the sustainability of the business, and it is not good for us as investors in the business. So it is very important that you remember that the dividend per share must always be lower than the earnings per share. I hope this is clear to you guys. We've come to the end of the lesson. I will see you in part 4 of lesson 1.